Our guest says the tailwinds that propelled stocks higher in 2024 are weakening. He thinks it's a great time to invest in high-paying dividend names, real estate, energy, healthcare, and basic materials. We're joined by David Sekera, Chief U.S. Market Strategist at Morningstar. David, great to see you. Thanks very much. There was near euphoria over technology last year, including AI. You think that's weakening now?
We do. We think a lot of the AI names, if not are fully valued, are starting to also become overvalued. In fact, when we look at the U.S. market overall, the market's trading at a 4% premium to a composite of our fair values. So at this point, I'm still market weight for U.S. equities, but over the past few weeks, I've certainly become increasingly more cautious. I think we're a little overextended in the markets here, in the short term. But I'm thinking about how 2025 is going to play out. As you mentioned, the tailwinds that propelled the market last year are really starting to slow down. When we look at U.S. monetary policy easing, we're looking for a reduction in the amount that they're going to ease over the course of this year. Inflation had been a big tailwind for most of last year, but now that's remained sticky for the past couple of months. And we're also seeing long-term interest rates climbing over the past couple of months as well. And you put on top of that, that the U.S. economic growth rate is still expected to slow for the next couple of quarters. And that explosive AI demand, I think that's going to start increasing at a decreasing rate. So a lot of different reasons why I like those high dividend paying stocks right now is I expect generally little price appreciation over the next couple of quarters at the index level until earnings start to catch up with valuations.
Kraft Heinz, we just talked about it. It's out of favor right now, hitting a 52-week low today. Yield, though, of 5.4%. Do you think that looks like a decent value?
We think so from a couple of different attribution points. So Kraft is a 5-star rated stock. That puts that in the highest rating category that we have. Trades at almost a 50% discount to fair value. Yeah, it's a company that last year we just awarded with a narrow economic moat, meaning that we think it has long-term durable competitive advantages. It's a company that had a lot of issues after they got bought out by 3G partners. 3G really put into place too many different systems that they were overemphasizing short-term value as against the long-term economic value of the company. We think that they've righted the ship, and from a fundamental point of view, we think it's very undervalued here.
Verizon Communications, the telecom giant, a yield of almost 7% right now. That's attracting you?
It is. It's another company we rate with a narrow economic moat, trades at a 24% discount to our long-term intrinsic valuation, puts it in that 4-star category. And again, the long-term investment thesis in the wireless industry is that in the U.S., there's really now only 3 major players, AT&T, Verizon, and T-Mobile. And what we've seen over the past couple of quarters is that it's starting to act a little bit more like an oligopoly. So they're competing less on price, and we expect operating margins to expand. Verizon lagged behind AT&T last year. We expect this is the year for Verizon to catch up to where AT&T is now trading.
And United Parcel Service, UPS, I forgot to check the yield here, but what draws you to this stock?
Now, from a dividend perspective, about a 5.25% dividend yield, yet the stock trades at a 15% discount to our fair value. It's a 4-star rated stock. We think it's a very high quality company. We award it with a wide economic moat. The short story here is that last year they had a lot of operating margin pressure. Essentially they had to renegotiate a lot of their wage contracts. So that put the company under pressure in the short term. Our analyst team is looking at a number of different cost savings that they put in place. Should it come to fruition, this year, as well as we're looking for top-line growth. So the combination of that should put the company back on track to see some good earnings growth this year and the next couple of years as well.
You see value in real estate, healthcare, and basic materials, including Healthpeak Properties, DOC in New York. Can you remind us what this company does, or how do they make money?
Exactly. So the real estate sector overall trades at an 11% discount to fair value. That's the most undervalued sector in our mind, right now. Healthpeak's rated 5 stars, trades at a 33% discount to our fair value, has an almost 6% dividend yield. And part of the reason that I like this stock is that we like a lot of these defensive real estate plays. Healthpeak, having most of its portfolio in, medical office buildings, some other healthcare properties, research and development properties as well. So we think that even even in any kind of potential economic downturn, that's much more of a defensive play within real estate, yet still has a very high dividend yield.
And in energy, you like the look of Devon Energy, DVN.
Exactly. So energy is the second most undervalued, trades at a 10% discount. Devon is a 30% discount to fair value, puts in that 5-star territory, well over 4% dividend yield, company that we rate with a narrow economic moat. And I really like energy here. I think it really does a couple of different things in your portfolio. With inflation having been relatively sticky, I do think it acts as a good natural hedge if inflation were to stay here, or actually if it were to move higher in the second half of 2025.
And then finally, Bristol Myers Squibb would be a name in health that you favor.
Exactly. And healthcare actually had a pretty terrible quarter last quarter. The sector is now trading at an 8% discount to fair value. And in fact, if you strip Eli Lilly out of that, which we think is very overvalued here, the healthcare sector is trading at an even greater discount than that. But Bristol Myers itself is a 4-star rated stock, trades at a 15% discount, over 4% dividend yield. It's a company we rate with a wide economic moat. Short story here is we just think that the market is missing the boat, that we think that the pipeline that they have, the research and development they have for new drugs is worth a lot more than what the market is giving it credit for today. Plus, we're looking for better earnings growth this year. I think too many people were looking at earnings last year, not taking into consideration a number of different accounting factors which held earnings back, which should normalize going forward.
And just on names that you are less optimistic about, Walmart, you think investors should consider selling those shares?
We do. Walmart is actually a 1-star rated stock. That's our lowest rating, meaning that we think it's one of the most overvalued stocks out there. Trades at over a 50% premium to our fair value. Short story here is I think the market is just over extrapolating the short-term growth that they've had, essentially with inflation over the past 2 years being relatively high in the U.S., seeing a lot of shoppers move from traditional shopping stores, traditional grocery stores to Walmart. But when we think about the long-term value of that company, we don't think it deserves a 37 times PE ratio.
And just finally, Home Depot, you think that investors might do well to lighten up on this one?
That's another 1-star rated stock, trades at a 32% premium. One of my big concerns here is, especially with long-term interest rates going up and with maybe short-term rates not coming down as much as people expected, I think higher rates will certainly put a lot of pressure on companies like Home Depot that sell the goods into the new construction as well as